probability trading strategy, you're full of crap.
If things aren't working, then that's a quick trip to the poorhouse.
To learn how to drive the beater before you can drive the Lamborghini.
Now you're playing with the house's money.
Wow, what an intro. Hey, guys, why do most traders fail when they follow strategies that should work? You know, could the myths we believe about trading actually be the real reasons why we're struggling? So today, we're going to dig into and reveal 3 myths that could be taking money out of your pocket. And we're saving the best for last because the basically, what is the one myth that if you don't, fix your beliefs on, will wreck your trading? And so we'll save that for the end. Hey, good morning. I'm Dennis Wilborn, the Autopilot Trader. Welcome to Trading Truths. Mike Lamothe is our co-host today. Hey, Mike.
Hey, good morning. Welcome.
And Mike is the founder of Mara Wealth. And together, we basically came together and we decided, you know what? We're going to debunk market myths. In other words, things people believe, false beliefs about the market, so that to help people jump over that hurdle and avoid a lot of the landmines.
Yeah, that's right. We love bringing on great people to help us debunk those myths.
Right on. And today is no exception. We've got John Pocorobba from Boston, right, John?
Yes, it's good to be here.
And John is over 25 years trading experience. He's the host of the Rain King Insights over on the YouTube channel. And, he's been defined as an expert growth stock investor. He's very active in the Boston. I think he is the organizer of the the Boston IBD meetup. And so, John, just tell us a little bit of how you got traded, how you started trading.
Yeah, this is interesting. I got involved when I was still in college, and what happened is a couple of friends in college had one guy knew a broker, and the guy said, "Oh, buy this stock. Here's a broker. Here's a tip." And young kids, we pooled our money together, and we got like $5,000 together, and we bought this company called Archer Communications on the Vancouver Stock Exchange.
Oh, wow.
The whole pitch was they had this thing called Q sound, which was this 3-dimensional sound they could project over 2 speakers that would enhance the music industry. And they had Madonna and Bruce Springsteen looking at it. So we bought the stock and things went up. They actually went from 5 to 20. And we were like, wow, this is really great, really easy. Soon we rolled it all over into another company called Foliage Plus, which made essentially fake plants that looked real. And they were like, the promise was they were going to be in every office building lobby across the country. And so what did we do? We rolled all our money into that. It was like $1 stock, and eventually it got delisted about a year later, and we lost all our money. So that was the first introduction to stocks. I'll say big highs and then wiped out. So from there, I got Bill's book, and like many, many people, dove into the book. Made a lot of sense in terms of some of the logic, some of the things to look for, and starting investing a little bit more soundly in the 90s. I probably didn't take advantage of the internet boom as much as I could have. I was very into my career in architecture at the time, but from there, really got much more serious in the early 2000s, 2003 and 4, coming out of that bear market. Is when I really said, okay, you got to put the time in. You really need to go to some workshops. You got to really, really study some stuff. So that's when I got much more serious about refining how I looked at the market and how I approach things.
Yeah. And recently you were on one of the spotlight speakers for the IBD National Meetup. And I know that your presentation to that group was just absolutely amazing because I categorize you, John, as kind of like a market historian, because I mean, is that a fair characterization?
Well, I definitely spend time looking at how the market has been prior, because I think there's value to studying the market and studying how bear markets start, how bull markets start, And being a growth stock investor, you want to know, when's the time to get in? What are the characteristics of those best stocks that have the potential to, double, triple, or more if you can get in them properly? And part of that's, studying the past winners, studying the market history, and really understanding how the market cycle works.
Cool. And so, anyway, so Mike, what kind of myths are we going to be asking John to debunk for us today?
Yeah, so a lot of people, when they first approach the market and start to hear about things and they start to dabble a little bit, they tend to, sometimes they'll have a little bit of success and sometimes they'll start to fail a little bit. They'll start to get tripped up and they'll take a look at this and be like, you know what, I think that all this stuff is rigged. And so they'll start telling themselves that story. So, John, what do you have to say about people that say that, I think that this whole system is rigged?
Yeah, I think as retail traders and people that try to get involved with the market, most people have some sort of educational background. They've gone to college, or maybe they're very successful in their career, and they're very successful people. And they say, okay, I'm going to tackle the stock market, kind of expecting that, well, I'll just translate my success into the market because I'm, quote, a smart person. And they probably are a smart person. But when the market's its own beast. It's a very complex, almost like a crossword puzzle that really never ends. And, we also know that the market is very competitive. You're dealing with the best minds out there. You're dealing with high-speed computer algorithms out there. And when things don't go so well, rather than the person admitting that, hey, I made a mistake, I did something wrong, they kind of resort to this myth to say, well, the market's rigged. If I can't make money and I'm a smart person, then something's rigged about the system. And really, that's not what's going on. It's about people really recognizing that to get good at anything, you got to put in time. You got to be open to really learning how the market works.
So what do you think's going on with the mindset of somebody? Because I mean, I'm sure the three of us have all been there, because we are all three of us quite successful in what we what we did in the past. At the same time, though, I know for myself, I stepped into trading and actually formulated a really great, profitable trading plan right from the get-go, but I wouldn't obey it. I just would go, basically, I don't need no stinking stock loss, stop losses and that kind of stuff. Blew up two accounts.
Yeah.
So what do you think the real reason is behind the losses, or this the mindset? What's kicking in with the mindset that causes somebody to basically default to, well, the market's rigged?
Yeah, I think, the market doesn't always act the way the natural human being acts. There's a lot of emotion in the market, fear and greed. And, when you're learning some of the things from Bill O'Neill or other investors, they talk about rules.
Yeah.
And they say, cut your losses short. And they say, and take your profits. And they talk about rules. And you probably nod your head and say, oh, those are good rules. Those are good rules. But then when they get into a trade, once you get into a trade and there's real action, your emotions go up tenfold. And the natural, and all of a sudden you get very uncomfortable because of the uncertainty of the market, and part of trading is being uncomfortable because you don't have all the information. So putting on risk, you have to be able to be uncomfortable, being uncertain a little bit. Obviously, you need to manage your risk and protect your account. But I think the emotions are what really, really take over people. And sometimes they short circuit their trades. They'll actually get so uncomfortable that they want to relieve that discomfort. So they'll take the trade off before a stop is even hit. And it's just, it's not comfortable. So it's, and they don't follow the rules. When you get really wrapped up in emotions, they just said, oh, I don't know what to do. They freeze up. I'm not sure. Maybe I'll get out of the trade, or maybe I'll wait, and it goes down further. and it gets very very difficult in your mind because you're not following those rules that sounded so simple in the beginning.
Yeah. So, Mike, you look like you have a question on this.
Yeah, so is this something that you've experienced yourself? And if you have, do you think that you might be able to share a story of, this is, I experienced this and here's how I eventually overcame it, or perhaps if perhaps maybe somebody that you've helped overcome something like that.
Yeah, I think for me personally, when you start out, I think Bill O'Neill says, "Oh, take a 7% stop. Just use a 7% stop," because historically he says, a breakout shouldn't really decline that much. And the first thing you're challenged with is, do I put in an order, a hard stop order, into the computer with my stop, or do I say, well, I'll mentally have a stop?
Mm.
And I can tell you, when I started out trading, I would say, oh, I'll mentally put a stop in, I'll get out here. And inevitably, again, when you're losing money, if you're down 5%, 7%, emotions are magnified 10, 20-fold. And you're probably saying, oh, that mental stop was hit, but you don't sell. Because you use probably the most fateful phrase. You say, well, I'll just give it one more day. As we all know, sometimes that one more day, you could be down 12%.
Mm-hmm.
And then your brain is confused. What should I do? Should I wait for a bounce? Maybe the bounce comes, maybe it doesn't. So one of the things that is, I think, very important when you start trading is a hard stop.
Mm-hmm.
And in order to establish what is that hard stop, you need to be, when you're starting out, you probably have a smaller account. You need to understand what you're comfortable losing, because as we all know, you're going to lose on a lot of trades, and you don't want any of those trades to be a disaster that could blow up the account. So you can look at percentages, whether it's a 5% stop or a 7% stop, but you could also look at it as what dollar amount am I comfortable losing on this trade?
Mm-hmm.
And whether that's 10%, 5%, everybody will be a little different. But I think when you're starting out, a hard stop is really, really important. Anytime, at least for me personally, with a mental stop, you tend to mess up the trade.
Absolutely. So for the person that comes by and is like, yeah, you know what, John, like I want to place that hard stop, but well, the moment I place that order, the broker sees it, and then they're going to try to run down and take my stop, and then I've just seen it run and rally right in my face, and it tends to do that to me every single time. Well, what do you tell those guys that have that in their head?
Well, that kind of plays into the market is rigged myth.
Right, exactly.
If you really think there's a market maker looking for your name on the order, I don't think so. I think you need to get comfortable saying, look, how do I manage my risk? Now, as we all know, there are orders that get exposed to the street, and frankly, anybody who uses technical analysis, and I'll say simple support and resistance, a lot of people have their stop orders right below the support level. Okay, the street knows it, and many retail traders are going to put their stop there. So if an institution really wants those shares, they will dump shares on the market. They'll push that stock down, and then they will grab all those stop orders and then ride the stock back up, creating a shakeout. That's exactly how a shakeout really is happening. So, but we also, I know that different brokerage platforms allow you to put conditional orders in orders that don't get triggered until certain conditions happen before they're immediately sent to the street.
That's right.
So there are ways to try to conceal, your orders, or at least conceal them to a point. So I know people use those. Actually, I'm one of the persons, I don't use conditional orders. I just put in my stop where I believe the right stop is, and I put it in there, understanding the risk. And, I think the things you can do is you could think about where you're placing the stop. I mean, certain stocks, have a certain volatility. And just looking at a simple, like a 14-day average true range, the ATR, if a stock moves 5% in a day, setting a 3% stop is an almost guarantee it's going to get hit.
Right on.
So you say, look, I want to stay away from at least one ATR. And if it's around earnings, you might want to be 2 ATRs away. So that's one thing you could look at, is the volatility of the stock. You could also look, what is the common place that most people will be placing their stops? Is there another place for you to put your stop earlier or a little later that's not so obvious? So there's a lot of considerations, but I know people that use conditional orders, and they love it and they live by it. So those work well too.
So yeah, I'm one of those conditional order guys also, and I love them. However, what I found is like TD Ameritrade, well, not TD Ameritrade anymore, but Thinkorswim, and I'm sure Schwab carried it on, is they claim that they hold the orders, even if it's a limit order, or a stop limit order or a stop loss order. They hold that until the price is actually hit or closest to the, and then they put it in. That's what, and so part of that, the market maker trying to drive prices down to trigger and take out some stops. I don't think they do that. I agree with what you said earlier, is that the market makers are not dummies, and neither are other traders. And so figuring out what I found for my own trading is, if I'm going to just put in a regular stop loss, is I stay away from whole numbers. In other words, I stay away from, $28, or I stay away from fives, $28.05, because those tend to be magnets, or people tend to place their stop losses, other traders. And so I'll go at, like midway, I'll go 28.08 for a stop loss or something like that. And it works for me fairly well, but I agree. But I love what you said about the ATRs. Following on with this aspect, because you've mentioned a couple of things, is one, emotions driving this, and which brings to mind, okay, what are 3 things that you would tell a beginning trader of how to manage or oversee their emotions, because emotion is going to be there when when they're starting to trade, and how does a mechanical system help you to control your emotional responses?
Yeah, no, emotions are going to be there. They're never not going to be there. It's a question of what is your game plan with your trade. And I think what's really important, and we teach this at Rain King Insights, is, every evening when you're doing your daily routine, you need to look at your positions, and you need to look at them and say, what's my offensive plan? If things go my way, will I be adding or just watching the stock? Or what is your defensive plan? Do you need to move a stop? What are you going to do if this position goes against you? And think it through when the market is closed. When you have no emotion, you think it through clearly and you write it down. It's very important to write it down in your journal or your trade plan, because that's going to be your game plan and you want to follow it. I think the other thing that is mentioned a lot with traders is having some basic rules. Rules are designed to help you, I'll say, dampen or really neutralize emotions, because you've already made some decisions to say, if it goes down 5%, that's where my stop is. I'm going to get taken out. There's no thinking. I've already accepted the loss. So that's why you want to make sure that dollar amount is something that isn't going to really upset you. It's not too much. So rules help a lot. I don't think having 3,000 pages of rules is good, because it'll get confusing. I do think you got to have, maybe it's 1 page of a paper. You have a page with, 10 to 15 rules that are about buying, maybe about selling, and also 10 or 15 rules, maybe that are related to managing the trade, holding positions, monitoring the trades, not getting shaken out. So rules help. Having a game plan you think through when the market is not open is really critical. I think that, when you're in the heat of the moment and you see your screen red or green, again, your emotions are only magnified 25 times. So that's not going to help you to be reacting to the screen with every tick. So we try to avoid, actually, what I really tell people in my membership is do not look at your account equity during the live market hours.
Yeah.
If you've thought through your trades and you have stops in, or if you have offensive sell orders in, they're just going to happen. And you don't want to be looking at your equity on a big up day and get excited when you don't want to look at it on a bad down day, because there's going to be both. And you don't want to make decisions when you're at these extreme emotional states.
Right.
So that is so good. I mean, that is so good. Mike, why don't you go ahead and let's jump into myth number 2. But before we get there, guys, remember, if you are finding this type of discussion with the great guests or on the Trading Truth podcast, remember, subscribe over on Spotify, YouTube channels for both Mike and I, and just and do us a big favor. Share the content with other peoples, because you know what? Between the three of us right here, we've probably, added all up. We're probably pushing about 100 years experience in the market. And so let us help you not step on the landmines that we already did. So Mike, jump into 2.
Yeah, well, just before that too, I had to mention, because John, you mentioned having like 100 pages of different buy rules and sell rules. I was that guy at one point, and I had like all the rules outlined from O'Neill's book and everything, plus stuff from IBD. And so when people told me, "Oh, narrow it down to just one sheet or put it on an index card," I was that guy that went with like the 3-point font and the magnifying glass to get it on that index card. And so I just thought that was funny. But you got to be able to handwrite it on there and make it nice and clean. And it takes a while to narrow down rules. But
yeah, actually, your rules really, most of your rules come out of post analysis.
Yeah,
when you really look at your trades, every quarter or every year, and you find anything that's a common mistake, then you say, I probably need a rule because I've made this mistake, I don't know, on 3 trades in a row or 3 trades over this past quarter. Then you can really say, look, this is a weakness and I need some help with a rule to help avoid this mistake. And so you end up with a very specific rule that's, your rule, because it's something you're working on to shore up in your trading. And, that becomes something new for the piece of paper. I think there are some, core ones that Bill O'Neill and others have that are absolutely essential, but eventually you're going to have more rules that come out of your post analysis.
Right on.
Right, exactly. All right. So on to myth number 2. So you've mentioned that the terms cheap and expensive are misleading in trading. Can you explain why this is and how it affects traders' decisions?
Yeah, I think, everybody thinks the adage, buy cheap and sell higher is the way to go. And, growth stock investing, and I'm speaking from a growth stock perspective, that's not really the formula. And there are really 2 words that I say, just eliminate those from your vocabulary, because relative to what? Cheap relative to what? And expensive relative to what? And what I mean by that is, I think it was about 10 years ago, Tesla's market cap exceeded GM. And people said, this is nuts. Tesla is so expensive. It's ridiculous. The market cap, how could they be over the market cap of General Motors? Well, look where we are today. Is Tesla cheap or is it expensive? Relative to what? The market the market is a discounting mechanism looking forward, and it was looking at Tesla's innovative cars and strategy and said,
Right.
this is worth more at the time than GM. So what's expensive can go much, much higher. And we know that if you study growth stocks. When a growth stock has gone up 100%, people say, well, I missed the move. Now, the best growth stocks can go up 2, 3, 4, 500%. So
Yeah.
it's not. It might seem that it's high because it's at an all-time high, but maybe it's a really strong company with a really strong product dominating their industry, and it can go higher. So when you look back, you'll say, wow, I put a little tick mark where I thought it was expensive, and 6 months later, you'll say, it now looks cheap. So it's a real oxymoron to use those words, because I think they hurt your mindset.
Mm-hmm.
Using cheap or expensive, because when you go through a bear market and the leaders top out, I think Bill O'Neill and IBD said the leading stocks will correct 72%, I think, off the top, which 72%. And there are examples when we peaked in 2021 of the leading stocks, they went down 80-90%. Look at Roku, look at Peloton. Every step down, when they were off 50% off their highs, you might have said it's cheap. Well, it got a lot cheaper. It was 70% off its highs. It was 80% off its highs. So those words, I think, they just bias your mind and they just limit potential. And I think you really, really want to avoid those. It's a myth to think of things in those terms.
So when something hits so do you primarily, are you a breakout trader or are you a pullback trader?
When I started out as a pure breakout trader and did that for quite a while. And I basically, my mindset was to buy strength. I always bought things at new highs that were breaking out, or they were coming off a pullback and got back to new highs. I was a total buyer of strength. And over the years, I found myself buying extended, getting shaken out on normal pullbacks. And so I said to myself, I need to really find some pullback strategies. So I'll have another tool in my bag that says, I have a strategy that says, here's how I'm going to buy on weakness and control my risk and do it in a way that was work with my psychology. So I forced myself to find a couple of strategies that would buy on weakness, really to complete, to have more things in the tool bag. And then I also looked at my strength buying and, recognizing some of these common areas where people have buy orders or sell orders, started to look at some other more refined techniques of where to get into stocks that are not so obvious as breakouts. I will take a breakout if I see a really, great volume profile. I see a lot of accumulation on the right side of a structure. I will take those. But most of the time, I'm using other earlier entries and different other ways to get into those stocks. So I probably moved a little bit away from pure breakout buying.
Mm-hmm. Okay. It's because sometimes I that's one of the things that a lot of times people talk about with IBDs, can slim methods, and all that kind of stuff, as far as buying breakouts. That, well, it breaks out, but then it returns. And part of my studies over the years has shown that, you get a breakout, but about 65 to 70% of the time, you get a small pullback, especially if it's a blue sky breakout, and oftentimes that's worth waiting for. But it comes down to percentages. How much of a pullback usually happens? 5%, 10%, and throwing in something to just, this cheap, expensive thing. How do you utilize like the moving averages, or are you straight buying off of, a level of defined support and, or selling against the resistance?
I do use moving averages. I tend to use the 10 exponential, the 20-day exponential, the 50-day simple, and the 200-day simple, which are very common moving averages. I will use when a big stock comes back into the 10-week line or the 50-day moving average, I will use the 65-day exponential moving average, because what I've learned over the years is, the institutions, well, they know retail investors like the 50-day moving average. It's a very common moving average. So what happens is institutions tend to try and drive the stock below the actual 50-day to some degree, to again hit a lot of stops, particularly if they want to increase their position. And I have found over the years that they tend to start buying again around the 65 exponential. Not all the time, but I think it's a decent guide, because I've seen a lot of shakeouts get driven down to the 65-day, and then they immediately tend to reverse. It's not perfect. I know people use other variations, but that's one that's not so common that I will use. If I see a stock get driven down below the 50 and then right around the 65, I see it immediately turn around and start getting volume, that might be a shakeout that I'm worth, entering a position.
Right. Do you apply also, John, on this cheap, expensive myth? Do you apply how do you apply things like Mark Minervini has some rules that he wants his price action to be above the above the 200. He wants the 50-day to be above the 200-day moving average also. And then that then he develops his trading from there. In other words, the basic structure of the chart is it's already started to reverse. Momentum is reversed and is heading up. Do you follow similar type things?
Yeah, I think the concept is getting the moving average just stacked appropriately, where the 10 is above the 20, above the 50. And you say generally when that's happening, you generally say we're in an uptrend. They're all stacked in a logical manner. I think that's a solid qualifier for setups. Now, when you come off a bear market, where stocks have been really, really beaten down, it takes a while for that stacking to occur. So I would not be bottom fishing off of that, but what I would like to see, and this is really comes out of Can Slim that some people overlook, is I want to see a prior uptrend. I'm not buying the lows, but if a stock can come off the lows by about 25 to 30% as a qualifier and then form a base, then I'm going to look at that base and I'm going to say, do I see accumulation in the base? Do I see big blue spikes? Do I see tight areas? Do I see institutional footprints? And if I see all that and it breaks out, I might give it a shot, even if the moving averages are not perfectly stacked, because I'm seeing accumulation. And if I had to wait for the moving averages after a bear market, it could be really, really late.
Yeah, really late. So Mike, what about you? What are the questions we have here on cheap and expensive, or what are the questions stimulated in your mind about cheap and expensive?
Oh man, so when it comes to cheap versus expensive, I try to, in a similar way, I try to eliminate those ideas from my mind, and also similar to Ray, and I think that we're all O'Neill students and students of the market, so we're looking at similar things. So looking for those same kind of tight areas in similar spots. I like that the tighter it is, the tighter the risk is, and so if we wait for those tight areas, then we're able to have much larger upside, have that reward side of the equation be potentially much higher than what it might be otherwise. Waiting, just if we're trying to get a move of say 20%, and let's say that you would need a 10% stop. Well, then you have a 2-to-1 trade. But if you have a tighter area where it's a 5% stop, now all of a sudden you have a 4-to-1 trade, and you're able to make a lot more money that way. You're able to have much lower risk, and your equity curve ends up thanking you for it, I think.
Yeah.
So
yeah,
not much of a question, just some extra thoughts there.
Well, I think you're right on. You've always got to think about what are you risking and what will the reward be? And part of that is about understanding your trading numbers. You know, what's your average gain? What's your average loss? Because if you find a trade, you got to risk 10% to make 20%, 2-to-1 ratio. You're kind of a 2-to-1 trader, but historically, you're actually a 3-to-1 trader. You're going to say that trade doesn't make any sense. I have to get 3 times my return for my numbers. So you say a 2-to-1 trade, you say that might be not very good. Now, if you are a 2-to-1 trader, it might be your bread and butter. And you say, this is great. But I agree with you. The tighter you can control that risk at 3, 4, 5% and get 5, 6R, that's a great trade. Might not work, but boy, if it does work, you're going to get the payoff for taking the risk.
Absolutely. And I love that you just mentioned too, like having that filter for yourself, because so many people too, especially when they're new, they'll tune into X, or they'll go to somewhere, try to find, well, what are the people that I respect, what are they saying about this trade? And somebody just posts, like, well, we all post on social media, I like this trade or that trade. And, oh, well, if this person happens to like it, then maybe I should be going into that one. But it should be filtered through the lens of your rules or your plan, or something that you've written, your own written documentation. I call it a business plan, but whatever you want to call it, filter it through that before taking the trade.
Absolutely. Yeah. I mean, the whole kind of copycat trading, when there are lots of very successful people out there who have their own strategies, and they're very successful. And I think when you're new to trading, you say, well, this guy's really successful. I'm going to copy what they're doing. If they post it on X, whatever the risk reward is, they just say, I'm going to take the trade because this guy's successful. And, what's missing is that successful person's trading psychology could be very different than yours.
Mm-hmm. And that's good.
And if they take a trade that, we're using this example of a 10% stop with a 20% gain, 2-to-1, maybe this really successful trader is a 2-to-1 trader, and it's absolutely bread and butter. Well, the copycat trader comes in and takes the trade and says, oh my God, the trade didn't work out. I lost 10%. That's a lot of money. I shouldn't have done that. And you say, that's why you got to really try to avoid copycat trading, particularly hopping between different people with slightly different strategies, and try to, really, really build your own filter for the setups and the types of trades that really fit your mindset and your psychology, but also fit your numbers. Many people I know in the beginning, when we start trading, you're like, what are you talking about? My numbers, and you say, you really need to know every 10 trades, how many of those are winners and how many of those are losers.
Yep.
And what is your average gain and what is your average loss? And so it's not that complicated to track, and just do that for 3, 4, 5, 6 months to get a sense of the reality of your trading. And then you can build a really good trading plan around your numbers.
Right.
And then, of course, we can always try to improve our numbers, with post analysis, but you got to start with, real numbers rather than just kind of hoping.
You mentioned something there, John, and just reminds me is we all, I think we all start with, well, you reach a certain point in trading where you say, okay, I need to understand or know my numbers. And so basically you develop your system and you back test it. And so you have your planned numbers, okay? Like you said, 2-to-1 risk reward ratio, or, maybe that's your target area. But then there's the okay, that's planned, that's theoretical, but then you get into the other side of that where it's your actual trading numbers that come from real live trading. And so I know, like for mine, I look at at, I want to have no more than a max 7% stop loss, right? Loss. However, over time and over all the trades I do yearly and year after year after year, my actual loss per trade is actually down to about 3.5%. And also now there's a difference in the profit targets also. Some of the profit targets hit right on the nose, but it's also normally what I found, it's both the loss is less than what I planned for, but then also sometimes the profit is a little bit less than what I planned for. And then then I can modify my plan to basically take into account what it really is doing and really is producing. And hey, Steve King, you said crashing. Are you talking? Is everything going out okay on YouTube and various areas? Anyway, just wondered. So cool. And guys, we're ready to jump into what I think is the most exciting piece of today. It's been great so far. And make sure, again, let us know. Leave us some comments if you have some questions to ask that you would like to ask John. But let's get into the most impactful myth, and that myth is basically the belief that, this belief is the most important part of trading. And so, John, why do so many traders get caught up in finding the perfect buy setup, but then they gaff off concerns about the exit?
Yeah, the myth is, to be a good trader, you got to spend all your time finding the best buy setups, and use all these indicators and tools which are at your fingertips to say, entry is everything. And, frankly, entry is the easy part. We can all click on and say buy. As I mentioned, the problem is your emotions will go sky high once you've got the trade on, if you haven't really thought it through. And I think it was Mark Douglas I think it was Trading in the Zone. He said that the two biggest mistakes a trader can make are A, not cutting losses, a defensive plan, but more importantly, he said, not systematically taking your profits, offensive plan. And what I find with most of my membership is the number one thing they have trouble with is selling. They're saying, I don't know when to sell. And really selling is key. It's really, really important to actually you got to be a good seller in the market. Yeah. Whether you're selling defensively to cut or to say, how am I going to get out of this trade? Do I have a set target like risk reward multiple that I'm going to get out and just roll it over? Am I trying to play this trade out for a 100, 200% move because I think I've got the leading stock of the market? And what happens is people don't give enough time and study to what is your selling plan, because they get into a trade and it starts to work, which is fabulous, but they say, well, I want more. I'm going to hold it because I'm getting greedy. I think this can go up more. And they start not paying attention. And all of a sudden, the stock corrects a little bit. Things start to slip away. The gains slip away. They get kind of frozen up making decisions. They lack the discipline to follow that original plan that they had. And things kind of just slip through their hands. And they're like, wow, I had a 35, 40% gain. And now it's 10%. And I'm disappointed because I didn't sell right. So selling is very hard, much harder than buying. And people should spend more time on how to sell.
Okay. So, well, how did you teach yourself how to sell?
Well, when we would go to IBD workshops, Bill O'Neill would always talk about offensive selling. He would say, try to sell as the stock is still advancing. Because as it's still going up, try to sell into that strength. And, you hear him say, okay, But my post analysis was showing that I was always selling defensively on the way back down as things were breaking down. And Bill said, look, you should strive for 75% of your selling on the way up. And so I identified that and said, this is a problem for me because I was selling, 10% offensively and 90% defensively. And I said, I really got to work at this. I want to start shifting that and really studying more offensive sell rules, whether they just be things that were climaxing or overextensions on the upside, or if it was just risk reward to say, look, I'm looking at a 4R trade and you're going to just sell and not worrying about, is there more to be gained? And so over the years, I've gotten my offensive selling to be about 60% of my selling. So I'm not there yet in terms of getting to the target, but I'm a whole lot better than I was when I started, which was always defensive. And defensive selling always feels bad. You're like, I sold and I gave back a lot. And offensive selling is tough too, because you're saying, well, why would I sell now? I'm making a lot of money. I'm making money every day. Why would I sell? If you're in, MicroStrategy, you're just like, why would I sell? And say, well, it's climaxing, and it's really hard to get your brain to say, I have to force myself to at least start taking some off of the position.
So do you, look at an overlapping type of complex, in other words, where you basically sell on strength, but then on, things that let's say you wanted to hold on to 20% of the shares you bought for the potential longer term, and then you put in a defensive stop on that 20%, and then, but take your profits hard on the other 60% of the shares you have.
I don't exactly do it that way. If I think I know who the top, 5 stocks in the market are, the real leading stocks, and they're acting like real leaders, I'm not looking to incrementally sell them into strength unless I see a climax top, which is the really serious sell signal. I'm looking at how do I incrementally keep adding to the position appropriately to keep force feeding more money into that stock, because I'm trying to play it out for a 200, 300% move. So I'm trying to actually increase that size in a responsible way to get the big move. Now, other stocks, which are good growth stocks, but I don't think they're like the alpha dog. Those are the ones that I'm going to say, okay, those I'll quickly maybe sell into strength, take a multiple of risk 3 or 4 times, turn them over. And I'll keep them on my watch list because they may present another entry on a pullback or a new base. But the ones that I'm trying to play out as a model book, I try to treat those a little differently for the bigger move, because the bigger move takes time. You're going to go through some pullbacks, and you have to, probably the biggest challenge is you have to be willing to give back a chunk of profits in a 20% correction. And that's tough to do. But if you believe the stock is going to go up 100% more, you got to be able to go through a correction.
Yeah. So what do you think, Mike?
Yeah, I totally agree. And I think that depending on your psychology and your temperament, it's easier or harder to sit through some of those pullbacks. I remember early on going to chart school with Mike Webster and with Charles Harris, and both of them are trading Can Slim, but they're trading in polar opposite ways. Charles being the swing trader, and Mike holding on for a bit longer. And so that gave me some solace and all right, so I don't have to be the guy that sits through the 20% pullback. I could do just as good being a swing trader and being a little bit more active. So that's the strategy and the tactic that I started to adopt, being a little bit more active, where I'm going for more singles, doubles, and the occasional home run. Like Reddit never really gave me a reason to sell, so I was able to hold on for the bulk of that, and then re-enter last week when it broke out from the high type flag. But for the most part, being more of the singles and doubles player, managing with position sizing and turning over the account a little bit more actively.
Yeah. Yeah. The market, you can trade the market in a whole variety of ways. There's no one way that's right or wrong. You do have to find something that works for you. I know people that say, look, there's no way I want to give back 20%. I'm not comfortable sitting in a base that might last 4, 5, 6 weeks. I just say that's crazy. And there's nothing wrong with taking your profits and turning it over. Everybody's a little different. But like you said, Mike and Charles Harris, two super successful guys, completely different traders.
Mm-hmm.
So, John, one of the things that I'm thinking about here is okay, you basically have perfected your method and your routine, your strategy to start taking profits, how to take profits, and defining those stocks, that are going to go up a lot, that you think are going to go up a lot, because we all, none of us are fortune tellers. But for somebody who's really struggling in this with this aspect of taking profits, what are some incremental things that they can be doing on taking profits so that they learn to be a winner? What are some of the incremental things they could do where they would become more accustomed? It would become part of their routine. Oh, I'm going to take profits, and here's how I'm going to do it.
Yeah, I think getting part of trying to get your mindset shifted a little bit is starting to think in terms of R, risk reward. Really thinking about how much risk am I taking? How many dollars is that? And R is, 1, risk. And then saying, well, I'm trying to get a multiple of that risk to make this trade worthwhile. If I'm not going to get a return, why would I put my hard-earned money on the line? And so, probably Can Slim, they don't talk about it this way, but it's basically a 3-to-1 R.
Mm-hmm.
I mean, because 7% loss, take your gains at 20, 25%, 3-to-1. It's built in. It's a 3-to-1 trading system. So
That's
starting
right.
there, if people have a Can Slim background and they're reading Bill's book, that's what it is. It's 3-to-1. So I'd say start to implement that. If you're using a 5% stop, take profits at 15. And just start getting in the mode of kind of saying, this is kind of automatic. It's really the math, and let the math drive that to get a person more comfortable saying, yeah, I'm going to take a 5% risk. I'm going to get out of it at 15%. Now, over time, maybe as you increase position sizes, that shifts a little bit. Maybe you take half off at a certain level of reward. And, so you can start to play with, different sizes of positions too, as you get more experienced.
Yeah. Cause that's awesome. I like to, like you said, I like to identify, I look at it from a probability standpoint. So if I'm taking a 5%, let's say my max stop is 5%, and I'll look at, hey, I want to take a little bit off at 10%. At a 2-to-1, then I take off my next one at 20 to 25% and take off, half the position there. But what I'm coaching and teaching is do that until it becomes habitual. In other words, until it becomes part of who you are on how to take profits. Then, and that may take 3 months, 6 months, a year, but you get used to being a winner. And I think that's part of I think that's part of all three of us are wanting to do, is help people become a winner. And being a winner is basically, knowing when to take your profits. But and so that works out very well. And then once you know how to be a winner, then a person can start experimenting, or not experimenting, but changing their parameters slightly to hopefully improve their ROI, over time. So,
yeah, I think the concept that you mentioned is really important. Is you're talking about scaling, and which is important, because I think sometimes when you're new, you think it's all or none. I got to sell it all, or I got to buy it all, and you say it doesn't have to be an all or none, difficult decision. You can scale in, make a couple of purchases, and then at certain levels you can scale out without losing your whole position. And it helps because it breaks down a big decision into smaller incremental steps, which is easier to do if you're having trouble making decisions.
Wow. Yeah. Easier to digest too. I mean, it's easier to take a 5%, loss, but your position is only 50% of a full position. That 5% doesn't seem to beach up against the head, head and shoulders too hard.
Right.
Wow.
Yeah.
So Mike, what we got other questions in here about this myth.
And the scaling in and out, that's been absolutely key for me in being able to hold on or to be able to sit through some pullbacks too, because one of the things that used to freak me out is giving back all of the profit, or like seeing it get too big and then getting greedy and getting fearful. So being able to scale out of trades at different times, it's almost like letting some of the pressure out of the pot. Like if you had a pot of boiling water and you need to let some of the steam out.
Yeah.
Feels like that.
So John, do you think that it's almost as if this is boiling, talking about steam, just do a little, carry on from there. The boiling down of it is that there's two major rules that you need to have three maybe. Where to enter, and then what your stop loss is, and where you want to get out. And once you're into the trade, if you've already made your decisions about those where you to get out, you're basically, the trade is no longer in your control, and you just freely let it go, let the market do its thing. Is that a fair statement?
Yeah, I think that's a great way to put it, because like you said, if you thought it through, you're just trying to follow your plan.
Okay. So John, what are let's say, if you were advising, or maybe with your group over at Rain King, what if somebody came to you, they had never traded before, and they were wanting to say, hey John, I want to start trading but don't know how. What would you tell that person? How would you help them launch their trading career?
Well, I'm a huge believer in education, and that's actually how Rain King Insights started. It's all about growth stock investing education. I tried to build something that I wish was there when I was learning. And so building a sound education of all the components of trading, not just buying, not just selling, but trade management and risk management, and how do you add, and how do you do post analysis, and how do you interpret the general market, all these different components. So investing in education is important. And I know that a lot of people that have smaller accounts that are just starting say, well, I can't spend whatever is $300 on a seminar, or I can't spend $500 on this. I think that you have to change your mindset, because if you don't spend the money and you just go Wild West into the market, you're going to lose your $500 anyways.
Right.
Probably. And so you say, and if I had to go look back, something that seemed like expensive education, I would have done sooner to get a more sound base of what I was doing. And so I always tell people, invest in yourself and ask yourself, if I spend $500 on this program, website, can I make that $500 back in my trading?
Yeah.
If you don't think you can, then don't take the course.
Yeah.
If you say, no, I can make the $500 back if I apply this properly, then you say, it's kind of an easy decision. You say you should definitely do it. If somebody says, look, I'm going to buy a course for $500, but I'm going to make $1,500, why wouldn't you? Yeah. So I think education is important. I try to keep people away from, as I mentioned, tag-along services. I think are only going to help you to a certain degree before your personality is going to come forward, and it may or may not agree. So and obviously avoid I'll say exaggerated promises of some people on social media and websites that say, our system, has a 90% rate and we make millions of dollars, and that stuff is not good stuff to latch onto.
Yeah.
Even if it helped you in the short term, I don't think it's going to help you in the longer term, because you do need to be able to survive the ups and downs.
Right on. So you're not a Lamborghini guy?
I'm not a Lamborghini guy.
Mike, are you? No, I know Mike's not a Lamborghini guy.
Yeah, no, it's yeah, I mean, boy, yeah, the thing that I think that matters most is I'd rather have a system that has a win rate of 50% instead of one that I'm relying on being right 90% of the time. Right? But when
Yeah.
you flip it that way, like, do you have to be right all the time to make money? Well, if you do, then the Lambo guy might be for you. But if you don't want to have to be right all the time, well, then you have a bunch of people here that say that, no, you don't have to be right all the time. You just need to know how to manage your trade. And
So, John, I want to say that the discussion has been absolutely amazing, and there have been so many golden nuggets left out there, folks. And so, the question I ask you is, drop us, Mike and I, on notes, and what myths have you believed that might be holding you back? Because Mike and I would definitely like to address those. And so, summarize the myths that we covered today with the most, I think they're all three very important. The number one is, is the market rigged? And knowing the difference between knowing the definition, or what is the difference between cheap and expensive. And above all, having that plan for, stop being a deer in the headlight when it comes to selling. And John provided us a lot of good information on that. You can find John over on X at JPOCO722. And then, John, what's your YouTube channel that you doing all your majority of your stuff through your YouTube channel?
Yeah, sorry. YouTube channel is Rain King LLC.
Okay. And then that'll link you back up. And so when we post this, we'll put John's links so you can go find out more from John. And again, John, it's been an absolute pleasure. Any last and final thoughts from Mike and I from you?
No, we're in a good seasonal period for the market. The market's acting really, really well. So, when you're in a good environment, try to take advantage of it as much as you can, because we all know there's other periods of time where things are kind of dead and challenging. But right now, I'm very optimistic going into 2025. As I shared at the IBD National Meetup, I think a number of things are coming together for, a really good 2025.
Agreed. And so, anyway, hey, S. Jordan, thank you very much. And please, share that. He said that it's a great video so far, and he's going to watch it again. Mike, what's your final thoughts for today?
Yeah, I was going to say that I echo S. Jordan's sentiments there, that this is one worth watching again. It's worth listening to again. There's lots of great nuggets. And it's been fantastic meeting you today, John. Thanks for being here with us.
Thanks so much for having me. It was a lot of fun. You guys have a lot of incredible people on this, and the material that you're putting out there is just great.
Appreciate that, John. So, okay, guys, hold on, because we're gonna basically end the live stream. So I just want to say aloha and God bless everybody, and have a wonderful Thanksgiving. And remember, this week is only 3.5 days worth of trading, and we're then rolling into the last 4 weeks for the year of 2024. Aloha. See you guys. Hold on, John. Hold on, Mike.